Okay, in this lecture, we're going to study Chapter 7, Interest Rates and Bond Valuation. We're going to apply discounted cash flow valuation techniques that we have developed in the previous lectures to value a bond. So what is a bond? When a corporation or government wishes to borrow money from the public on a long-term basis, can do so by issuing or selling debt securities, and debt securities are generically called bonds. Bonds may have some complex features, but in its most basic form, bond is a pretty simple thing. So you as an investor lend the company some money, say $1,000, and the company issues debt security. That states that IOU, and the company pays you interest on a regular basis, and it repays the original loan amount of $1,000 at some point in the future. And the bond looks like this. It's an example of US Treasury note. And there are many terminologies about a bond. The face value or par value is the principal amount of a bond that is repaid at the end of the term. So in this example, the face value is $1,000. And this bond is issued on February 15th, 1979. Issued February 15th, 1979. It's hard to see from the screen, but you can see it from the lecture slides. And it's due on February 15th, 1987. So this is our 8-year-old, the 8-year bond. And this is called a maturity. The maturity is specified date on which the principal amount of a bond is paid. So in the meantime, bonds pays interest, so which is a coupon. So here are the coupons that are attached to the bond. Coupon is a stated interest payment made on a bond. So on February 15th and August 15th, so it pays $45, which is a coupon. And coupon rate is the annual coupon divided by the face value of a bond. So here, the annual coupon is $90. So you receive 2 of those in a year. The face value is $1,000. The coupon rate is 9%. So this is an 8-year, 9% treasury note. And yield to maturity, or simply yield, is the interest rate required in the market for the bond. So how do we value a bond? So we must understand the cash flows the bond typically generates. So bond makes the periodic interest payments, which are the coupons. So in this example, the coupon is $45. Also, at the end of the term, the bond pays the principal, or the face value, or it's called par value. So the value of a bond is simply the present value of all the cash flows. The present value of these cash flows. There are two parts to these cash flows. The first part is the present value of its coupons, and the coupons are in the form of an annuity. So the present value of these coupons is simply the present value of an annuity. So C over R times 1 minus 1 over 1 plus R to the T's. And there's here principal payment or lump sum payment at the end of the term. So the present value of this is face value divided by 1 plus R to the T's. So that is the present value of a bond. So again, there's two parts. The present value of annuity, which is coupons, and plus present value of a lump sum payment at the end. So this is a bond price formula that I want you to remember. So let's look at an example. So your firm would issue a bond with 10 years to maturity. The bond will pay the bondholder $80, which is coupon, each year for 10 years, and $1,000, which is face value in 10 years. So it makes annual coupon payments of $80 each year for 10 years, and it pays $1,000, which is the face value in 10 years. If the going interest rate in the market on similar bonds is 8%, so this is market interest rate is year to maturity, is 8%. And the question is, what would this bond sell for? The bond price should be the present value of all these cash flows. So the present value of annuity part plus present value of the face value. Okay. If you compute this, you get $1,000, which is the same as the face value. This is always the case if year to maturity is equal to coupon rate. The coupon rate is 8%. 80 divided by 1,000, that's the coupon rate. And year to maturity is also 8%. When year to maturity is equal to the coupon rate, the bond price is equal to the face value or par value. And the bond is called par bond. Okay, let's carry on with this example. Suppose a year has gone by and the interest rate has risen to 10%. So from 8% to 10%. And the question is, what will the bond be worth? So now, interest rate is 10% because year has passed. So T is 9. So the bond has 9 years to maturity instead of 10. So the price of the bond should be 80 divided by 0.10, 10%, instead of 8%, times 1 minus 1 over 1 plus 0.10 to the 9th, plus 1000 over 1 plus 0.10 to the 9th. Okay. As interest rate change from here 8% to 10%, the bond price will change as well. So if you compute this, you'd get $884.82. As interest rate goes up, the bond price goes down. Interest rate and the prices, they always move in opposite directions. As you can see here, interest rate is in the denominator. So R goes up, present value goes down. Okay, so they always move in opposite directions. So instead of rising, what if the interest rate had dropped by 2%? Okay. So in this scenario, interest rates dropped by 2%, so to 6% now. And what would the bond sell for if that had been the case? So in this scenario, interest rate is 6%. The years to maturity is 9 years. The present value is 80 over 0.06 times 1 minus 1 over 1 plus 0.06 to the 9th plus 1000 over 1 plus 0.06 to the 9th. So if you compute this, then you get $1,136.03. As you can see here, again, if interest rate goes down, the price goes up. So they always move in opposite directions. So in the first scenario, year to maturity, which is 10%, is greater than coupon rate. What that means is that the similar bonds in the market are paying 10%, whereas this particular bond is offering 8%. So this bond is less attractive compared to other similar bonds that are being issued in the market. So this bond is being traded at a discount to compensate for that. So this bond is called discount bond. On the other hand, the second scenario, year to maturity, which is 6%, is less than coupon rate. So that means that other similar bonds are offering 6% when this particular bond is offering 8%. So this bond is now attractive relative to other similar bonds in the market. So now this carries a premium. So this type of bond is called premium bond. So this is an important relationship between coupon rate and yield to maturity. The coupon rate is determined when the bond was issued. So investment banks like Goldman Sachs try to set the coupon rate equal to yield to maturity at the time. So it depends on the risk characteristics of the bond when the bond was issued. But market interest rate change over time, but the coupon rate and the face value stay the same. So as interest rates change, bond prices change as well. So you as an investor, if you buy a bond by paying price P0, so you pay P0 to buy a bond. If you sell it a year later, then you receive coupon C, and the resale value or resale price of the bond, P1, then your return will be C plus P1 minus P0 over P0. So you can divide into two parts. So this is the first part, C over P0, plus the second part, P1 minus P0, which is a price change over the current price. So that's your return. Yield to maturity is your expected return when you buy this bond. This is the average return you're going to earn if you hold the security, hold this bond until maturity. And this is called current yield. Which is often used in practice. So don't be confused with yield to maturity. Current yield is a bond annual coupon divided by its price. So for discount bond, current yield will be lower than the yield to maturity because the current yield considers only the coupon portion of the return. So it doesn't consider the built-in gain from the price discount. So in the previous example, so discount bond, if the level of interest stay at the same level, then bond prices would converge to the face value, gets closer and closer to the face value, which is $1,000. Similarly, the premium bond, the prices would converge to the face value over time if interest rates stay at the same level. So with discount bonds, you expect to earn positive gains from price changes. This is called capital gains yield. In contrast, for premium bond, the opposite is true, meaning that current yield will be higher because it ignores built-in loss. So let's look at an example. So there are many yields. So the current yield is, again, the annual coupon divided by its price. So here, we're looking at a 7-year, 14% semi-annual coupon bond with a face value of $1,000. And this bond is quoted at $971.56. So this bond makes semi-annual coupon payments. So $70 every 6 months over 7 years. So the T is 14. And the annual coupon is 140, so 14% of the face value. So current yield would be 140 divided by the current price, 971.56, which is 14.41%. So that's the current yield. How about yield to maturity? Yield to maturity is the interest rate that set the price of the bond equal to the present value of the cash flows associated with this bond. Which is a market interest rate for this bond. So we can solve for R using trial and error process that I introduced in the previous lecture. This time, I'm going to use a financial calculator to save time. So let's look at the cash flows. And at time 0, you pay, if you buy this bond, cash flow will be negative 971.56. So this cash flow fits naturally into a financial calculator, which looks like this. So there are 5 keys here. N, I over Y, PV, PMT, and FV. So let's connect the financial calculator keys to the numbers in this problem. So N is the number of periods or number of payments. So 14 in this case. And I over Y is the interest rate that we want to figure out. So in this case, R, which is unknown in this problem. And the present value, PV is the present value, which is here. And financial calculator makes distinctions between cash outflows and cash inflows. So you have to input the signs of cash flows correctly. So in this case, a present value, you have to input negative 971.56, because as an investor, from investor point of view, when investor buys the bond, investor pays this price. And in return for this, bondholder can receive the following cash flows, which will be cash inflows for their bondholders. The payment is the coupon payment, which is 70, and the face value or the future value of the lump sum payment is 1,000. So in this equation, there are 5 variables. So you know 4 variables. So you can solve for the 5th variable, which is R here. So in the financial calculator, so I'm going to input the values for 4 variables that we know, and we can solve for the 5th variable. So before using the financial calculator, it's important to clear the registers. So by clicking second and clear TMV. So the $1,000 is the face value. The payment is 70. And the present value is 971.56. To put the negative sign here for the present value. And number of periods is 14. And going to compute interest rate. So compute interest rate that give you 7.3%. But this is not yield to maturity yet. Interest rates are quoted as APR, annual percentage rate, and yield to maturity is not an exception. So this is interest rate per 6 months. So we have to annualize it. So yield to maturity is 14.66%. So this times 2. Now this is an annual number. Then what is the capital gains yield? Where capital gains yield is a difference between yield to maturity and current yield. So this should be 0.25%. Okay, so that's a lot of years, and there are more years to come, which is called holding period yield. So yield to maturity on a bond is the interest rate you earned on your investment if interest rates don't change, or if you hold the bond until maturity. But if you actually sell the bond before it matures, your realized return will be different from yield to maturity. And your realized return is known as holding period return, holding period yield. So in order to find holding period yield, you must consider the cash flows from your investment. So let's look at an example. Suppose that today you buy a bond with an annual coupon of 7% for $1,060. And the bond has 21 years to maturity. So this is an annual coupon bond. So it makes annual coupon of $70 for the next 21 years. So the question is, what rate of return do you expect to earn on your investment? So this is asking, what is yield to maturity? So you can find yield to maturity using a financial calculator as before. So here, N is 21 and PV is negative 1060. PMT is 70 and FV is 1000. So Let's clear TMV first. So 1000 FV 70 PMT negative 1060 PV and 21 is N. Now I compute I over Y. I'll get 6.47 cents. And that is yield to maturity because period here is a year. So this is already an annual number. So that is yield to maturity. We don't have to multiply that by 2. So you purchase the bond at 1060. And 2 years from now, yield to maturity on your bond has declined by 1%. So yield to maturity becomes 5.47%. So this is the good news for you because if interest rate goes down, bond prices go up. So you decide to sell your bond. And the question is, what price will your bond sell for? So you have to compute the bond price. So I'm going to use the financial calculator to find the bond price. So I can input 4 variables, the known 4 variables. I can solve for unknown 5th variable. So the face value is 1000. The payment is 70. And now number of periods will be 19 years because 2 years has passed. 21 minus 2. So 19 years left to maturity. So yield to maturity is now 5.47%. So if I compute present value, then I'll get $1,178.02. As you can see here, bond price has increased considerably. So now we can compute holding period yield on your investment. So let's look at your cash flows. So your cash flow is over 2 years over your investment horizon. So you receive coupons and you receive this resale price. And your holding period yield is your return. So interest rate that equate the cost of your investment to the present value of your cash flows. So 1060 equal to 70 over R times 1 minus 1 over 1 plus R squared plus, that's the present value of this, and present value of that, 1178.02 over 1 plus R squared. So again, this type of cash flow fit right into the financial calculator. So now we have N is 2 and present value is negative 1060 and payment is 70 and the future value or the lump sum payment later is 1178.02. Then we can compute I over Y. So first, clear the registers. So second, clear TMV. So the future value is 1178.02. Payment is 70. And the present value is 1060, negative 1060. And number of periods is 2. And we compute I over Y. So that is 11.86%. So that is your holding period return. So luckily for you, because interest rate has declined, you earned higher returns than what you expected 2 years ago. But if things have gone in the other way, you may have earned lower returns. So in this way, bondholders face risk from this change in interest rates. And this type of risk is called interest rate risk. And all other things being equal, the longer the time to maturity, the greater the interest rate risk. So here we're looking at 1-year bond and 30-year bond. So bond price and interest rates are inversely related. For 30-year bond, long-term bonds are more sensitive. The prices are more sensitive to changes in interest rates. And short-term bonds are less sensitive, as you can see here. So long-term bonds have greater interest rate risk. So that's why typically long-term bonds have higher yields than short-term bonds, other things being equal. Also, or other things being equal, the lower the coupon rate, the greater the interest rate risk. So we have seen some basic bond features, but there are more bond features. But we're not going to see all of these bond features. So one bond feature that we're going to look at is bond ratings. So most public debt is rated according to the creditworthiness of the lender by rating agencies such as Standard & Poor's or S&P and Moody's. And bond ratings are issued to classify the level of default risk, meaning that the borrower may fail to repay the promised bond payments to bondholders. So default risk is another risk factor for bondholders. So AAA rating is the highest rating that bonds can achieve, and US Treasuries and blue chip companies like Microsoft has AAA ratings. And other issuers may have lower ratings, and the bonds with ratings from AAA to BBB are considered as safe. So these are called the investment quality bonds. And bonds with lower ratings, lower than BBB, are considered junk bonds. And these are very risky securities. And nowadays, junk bonds are called high yield bonds, powerful marketing purposes. So investors recognize that issuers other than the Treasury may or may not make all the promised payments on the bond. So they demand higher yield as compensation for this risk. So that's why junk bonds have very high yields. So this extra compensation is called default risk premium. And a common measure of default risk premium is the yield spread between BBB bonds minus AAA bonds. So yield on BBB bonds are almost always, not almost always, always higher than yields on AAA. The spread is always positive, as we can see in this figure. The shaded area indicate recessions, and this is the most recent financial crisis in 2008. As you can see here, the default risk premium increased dramatically here as investors sell risky bonds and buy safe bonds. So this pushes up the prices of AAA bonds and lowering the yields on AAA bonds, making the default spread larger. So this type of things happen when people fly to safety. Another economic indicator that is associated with interest rates is called term spread. This is about the term structure of interest rates, which is relationship between short-term and long-term interest rates. And term structure of interest rates are often represented by yield curve on the treasury bond. It's a plot of the yields on treasury notes and bonds relative to maturity. So as you can see here, yield goes up as maturity increases. So yield curve is normally upward sloping. However, sometimes yield curve is inverted, so may have downward sloping, meaning that long-term yields are lower than short-term yields, which is pretty unusual. Here, this figure shows the term spread between 10-year US Treasuries minus 3 months US Treasuries. So 10-year minus 3 months. Usually positive, as you can see here, but sometimes it's negative, meaning that yield curve is inverted. Again, the shaded area represent recessions. It happens that yield curve are inverted just prior to recessions. It's happened before the most recent financial crisis in 2008. And again, more recently, it happened around at the end of 2019 or early 2020. Now we're currently having an economic crisis due to the COVID-19 pandemic. So this seems to be a good forecaster of the financial crisis. So this is all I want to talk about in this lecture. Thank you for watching. I will see you next class.